Hey, what's up everyone? It's your boy Alex here with another weekly freight market update. Today's date is September 11th, 2025, and I'm going to answer the question we're all asking. Did the market go up as expected after Labor Day? Look, I've been in this business for over 2 decades. I've seen the dot-com crash, the 2008 financial crisis, COVID disruptions, but I'm going to be straight with you. What we're experiencing right now is different. This downturn has lasted longer than anything I've witnessed in my career, and I know many of you are feeling it. But here's the thing, knowledge is power in this business. The more you understand what's happening and why, the better decisions you can make to not just survive, but position yourself for when this market turns. And it will turn. Let's start with the hard numbers. The van market is sitting at a 6.9 load-to-truck ratio. That's essentially flat week over week. National linehaul is averaging $1.69 per mile, with the top 50 lanes hitting $2.03. Now, here's what these numbers really mean for you as an owner-operator. A 6.9 LTR means there are still more loads than trucks, but barely. It's that sweet spot where brokers start getting picky, and you need to be strategic about which loads you take. Reefer is actually showing some strength with a 10.8 LTR and $2.06 per mile line haul. If you're running Reefer, you're in a better position than most right now. Flatbed operators, and I know many of you watching run Flatbed, you're seeing the strongest market with a 23.1 LTR. That's real leverage, and we'll talk about how to use it. Now, let's dig into what's actually happening in the van market. We're seeing what I call a post-holiday volume pop. Loads are up slightly, but here's the kicker. Truck postings are down just a bit. This creates that marginal improvement we're seeing. I remember back in 2019, we'd see these post-Labor Day surges that would carry us through peak season. This year feels different. The Midwest hubs are your cleanest outbound options right now. Chicago, Indianapolis, Kansas City. These markets have the freight diversity that keeps you moving. But here's something concerning I'm seeing. Contract bleeding. Tender rejection rates are sitting in the mid-single digits, which means shippers are pushing more freight to the spot market. Now, short term, this might seem like good news for you. More spot freight, right? Wrong. What this really signals is that contract rates are so low that even those aren't sustainable for carriers. When contract freight bleeds to spot, it usually means the economic fundamentals are still weak. If you're running Reefer, here's the practical reality. Loads are down week over week. Your load-to-truck ratio is still healthy at 10.8. That $2.06 per mile line haul, that's workable if, and this is a big if, you're managing your ancillary revenue correctly. Here's something I learned the hard way early in my career. I took a Reefer load from California to Florida for decent money, but I didn't negotiate detention properly, sat at the receiver for 14 hours with no compensation. Never again. Right now, with Reefer rates where they are, you need to leverage every opportunity for additional revenue. Negotiate detention terms up front. Get it in writing. Those night and early morning delivery windows, they're paying them for a reason. You better make sure detention compensation is crystal clear before you commit. Flatbed operators, this is your time. 5 weeks of steady volume streak, and you're looking at load-to-truck ratios in the 20-plus range. When truck posts go down and your LTR goes up, you've got real negotiating power. The energy and infrastructure projects in Texas, the South, and parts of the Midwest are driving this demand. I'm talking oilfield equipment, wind turbine components, construction materials for data centers. This isn't seasonal freight. This is structural demand from America's infrastructure build-out. Here's a story that illustrates this. Last month, I was talking to an owner-operator running a flatbed out of Houston. He was consistently finding loads at $2.50 per mile because he specialized in oilfield equipment. The key? He knew which lanes were infrastructure-driven versus commodity-driven. Let's talk regional strategy. Florida continues to be a tale of two markets. Inbound to Florida is paying $2.42 per mile. Decent money. But outbound, $1.12 per mile? That's brutal. I've been watching the Lakeland and Miami markets specifically. There's freight there, but it's priced like it's still 2020. You're essentially subsidizing the inbound freight with that cheap outbound rate. Texas is a different story. Dallas, Houston, Laredo, these markets are rich in both van and flatbed opportunities. the cross-border trade keeps Laredo consistently hot. Here's my tactical advice if you're stuck in Florida. Plan your escape with 2 short hops. Florida to Georgia or Alabama, then Georgia or Alabama to a better hub like Atlanta or Nashville. Yes, you're giving up some miles, but you're trading bad rates for market position. Now, let's talk about tools you can implement today. I call these dispatch filters, rules that help you make better load decisions faster. First, the soft floor rule. Decline the first okay offer you get. Counter the second offer by 6 to 10 cents per mile. This isn't about being difficult. It's about understanding that first offers are rarely best offers, especially in today's market. Second, saved searches. Set up alerts for Texas flatbed freight in Houston and Laredo corridors. Create searches for Midwest van hubs. Let technology work for you instead of scrolling through endless load boards. Third, deadhead caps. Predetermine the maximum miles you'll deadhead for different rate levels. Don't make emotional decisions when you're sitting empty. Have your rules, stick to them. Here's something that's going to impact many of you. English language proficiency out-of-service violations were reinstated effective June 25th, 2025. This isn't new, but enforcement is ramping up. Expect increased checks on major corridors, and translation aids are not accepted. For carriers, you need to add simple ELP screening to your driver qualification process. For drivers, practice CLE inspection phrases. I know this feels like one more burden when you're already dealing with tight margins, but an OOS violation costs you time and money you can't afford to lose right now. Here's your actionable playbook for this week. Van strategy, favor the Midwest. Use that 2 offer rule I mentioned. Pay attention to dwell time reviews. If a shipper or receiver consistently causes delays, factor that into your rate calculations. Reefer strategy, enforce detention terms. Confirm those night and AM delivery windows up front. Don't assume anything. Flatbed strategy, target those Texas and Southern infrastructure projects. But here's the critical part. Verify load readiness. Make sure cranes are available, permits are in order. A $3 per mile load becomes a $1.50 per mile disaster if you're sitting for 2 days waiting for equipment. Look, the key takeaway from this week's update is this. Post-holiday activity doesn't equal free money. We're seeing green lights, but you need to avoid the classic traps. Bad outbound lanes, poor detention terms, inadequate deadhead compensation. Smart pricing means pricing the ugly lane up front. Sometimes 2 $1.80 per mile short hops beat 1 $2.20 per mile long haul that leaves you stranded. After 2 decades in this business, I've learned that survival isn't just about finding freight. It's about finding the right freight at the right price. This downturn won't last forever, but the operators who emerge stronger are the ones making smart decisions right now. If this kind of practical, no-nonsense market analysis helps you make better business decisions, please hit that like button and subscribe for more valuable content in the trucking business. Drop a comment and let me know which lanes you want me to cover next week. Until next week, keep your wheels turning and your margins positive. We're going to get through this together.